everybody thinks that inflation is the enemy. Inflation is one of the most backward-looking economic indicators, and really the inflation now was baked in the cake 18 months ago.
Yep.
So my job in global macro analysis is to look forward 18 months and say, what will the world look like? Just the rate of change comparison of price changes is likely to lead to very low inflation numbers. And housing and wages are always the longest lags. So over the next 6 months, we'll start to see them roll over too. So my guess is if we were to have this call in a year's time, inflation is closer to 2% than it is to 9%, which is a shocking turnaround in events. I think inflation goes negative.
Inflation and its crippling effects on consumers, businesses, and the economy have been the focus of economists and financial regulatory bodies around the world for most of the year. On Thursday, the European Central Bank announced its third consecutive interest rate hike for the year. In addition to the massive 75 basis point hike, the central bank changed the terms of its targeted longer-term refinancing operations. The move is in a bid to bring down the 9.9% 40-year high inflation recorded in the euro area in September. The Bank of England is also expected to announce its biggest rate hike in 33 years this week. According to recent estimates, economists expect the Monetary Policy Committee to announce a 75 basis point hike in early November. If it does, it would be the biggest increase to the base rate since 1989 and the central bank's 8th consecutive rate hike to combat inflation. During its meeting this week, the U.S. Federal Reserve is also expected to announce another 75 basis point hike and debate the size of succeeding increases to its benchmark rate. According to Fed Governor Christopher Waller, there will be a very thoughtful discussion about the pace of tightening at the meeting, which is scheduled to hold between November 1 and 2. The rate decisions of these and other key central banks are expected to have far-reaching effects on asset prices in the coming weeks. In a recent interview, macro guru and former Goldman Sachs executive Raoul Pal discusses the current macro environment and how the actions of key central banks could impact the global economy in 2023 and beyond. Please watch, share, and like this video as Pal delves deep into the global macro environment. Also, ensure you subscribe to the channel, drop your comments and observations below, and turn on post notifications so you get notified whenever we upload a video. Thanks and enjoy the video.
But then I look at the oil price come down from $120 to, where are we now, about $80. We've seen stuff like steel down 70%, lumber down 70%. Almost all commodities have come down. So those supply shocks have gone. The other supply shocks you used to be able to see in shipping prices and stuff like that. Well, shipping prices have come down. So almost all the forward-looking indicators of inflation are coming down. So now the market's fixated on wages and rents. Well, the house prices are coming down. We're already seeing that. Demand for housing has collapsed. And housing and wages are always the longest lags. So over the next 6 months, we'll start to see them roll over too. So my guess is if we were to have this call in a year's time, inflation is closer to 2% than it is to 9%, which is a shocking turnaround in events. I think inflation goes negative. So if I'm right that growth is imploding and inflation is about to evaporate, then the probability of the central banks coming in yet again to try and support growth goes up exponentially. Let's assume I'm wrong then. The flip side of this is let's assume that the moment that there's any sort of recovery anywhere, that oil prices go up because there's a supply issue in the oil markets and some of the commodity markets like copper. Yes, that's possible, but you have to have really high oil prices to have the same amount of inflation. So could inflation be sticky at around 4 or 5%? That's where the market is talking about it on Twitter loudly, all the economists. But I'm looking at the 5-year break-even inflation rate, where inflation rate is expected by actual market participants in 5 years' time, and it's currently at 2.2%. 1 year break-even inflation is 1.75. So the market's actually pricing in something very different than the narrative. So I think it's setting us up for actually a big shock compared to what people think, because we've been told inflation, 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 that's the fear. I think the next round is falling inflation, falling growth, rising unemployment. People always anchor on the past, right? There's a heuristic bias within macroeconomic forecasting. And generally it's to do with what is your big bogeyman? What is your fear? Right? So everybody who's seen central bank printing, the excessive use of interest rates, who are slightly older, so particularly the baby boomer generation, their big fear is the 70s. Right? Anybody who's in their 30s has never seen anything but low interest rates. There's an argument over who's right, because these baby boomers have been saying, we want to prove that we're right, that this was the wrong move. And they anchor on the 1970s, saying inflation came down after the oil shock of 74 and then went back up. However, this time around, we're missing those baby boomers we started this story with, who turned 30. That we don't have that more. We've got the largest number of retirees in all recorded history. And countries like Japan, Switzerland, Italy, Spain have shown us what that means. It means they stop consuming. I remember when my father retired, you know, he was in a good earning job and he had a reasonable amount of savings for his retirement. The moment he retired, you're faced with one thing: is how long am I going to live for? How long is my wife going to live for? And do I therefore have enough money? And so what you do is stop spending. I mean, he must have reduced his spending in the first 3 years of retirement by 60, 70% because of this fear, because nobody wants to be 80 years old and be destitute. So you become naturally incredibly cautious, which is a huge drag on growth.
While governments, central banks, and investors are fixated on high inflation and increasing prices of goods, Pal believes there is a bigger threat to the global economy, which is the ultimate destruction of growth. According to the macro guru, the destruction of growth will force central banks to return to the printers, which would in turn cause more currency debasement, higher prices, and the inflation of asset prices. Let's get back to Raoul Pal's interview as he discusses the genesis of the problem and why central banks will always need to prop up the economy.
What I had realized is demographics are pretty much everything. Most people don't really think about it. But what happened back in the 70s when we had this last burst of inflation that's pretty famous, that everybody now wants to be Paul Volcker, that was driven by something unique, which was the highest number of 30-year-olds ever coming into the workforce. You know, that period of time was the baby boomers. There were 76 million of them. It was the largest demographic in all recorded history. And they all came into the consumption force at the same time. They got jobs, they got married, they had kids, they bought cars, they bought a suit, they bought a house, they bought a table, they bought a chair, bought everything. So we had this massive demand shock. But the other issue is they all came into the workforce at the same time and competed with each other for jobs. And then as we got into the 80s, they realized that their wages weren't going up as much as they expected. The American dream wasn't playing out. And Margaret Thatcher and Ronald Reagan started introducing the ability to get debt. So it became hire purchase for a car, and then mortgages, and everything became more and more available. So they topped up their income with debt. That was okay, but they then started to also invest in the stock market in their kind of late 30s when they got further into their career, creating this big stock market bubble that went on into the 90s. In the 90s, something else happened, which was, again, that constrained these guys. So not only were they competing with each other for jobs, but suddenly in 1996 onwards, the NAFTA, North American Free Trade Organization, and the WTO happened. Eventually, China comes into the labor force, into the global labor force in around 2000. So now the average American worker is competing with a Chinese worker who's earning 1/15 of their wages.
Okay.
So everybody starts moving abroad. Technology comes in, the rise of the personal computer, and then the internet, which means that they're more under pressure because, as Google knows full well, is everybody gets replaced by technology over time. So what happens is they took on more and more debts. Also meant that after 2001, which was the kind of the tech crash, they started moving into housing because these guys were now moving towards retirement. So they start moving towards retirement, and they're desperately trying to have enough money to retire, but they haven't been earning more than inflation over the last 30 years. So they're just not getting anywhere. So they start borrowing money. So now they've borrowed stuff for consumption, and then they start borrowing for housing. It ends up to be another bubble. It blows up again. This is now creating problems for the entire pension system, which is the other part of their future. So again, they continue to take on debt. But then now the governments realize this too. At 2008, the new invention of quantitative easing happens. And that's a way of governments basically debasing their own currency by printing more currency so you can kind of alleviate the value of the debt. But it also meant that asset prices went up, and these people didn't get any richer because they couldn't afford to buy the assets that went up. So the rich got richer and the average person didn't. So they borrow yet more money. We've now got a system where the government's, well, the central bank is helping support this very indebted system, which almost went bankrupt. We then get to 2012, and the worst case scenario starts to happen, which is Europe and these giant sovereigns. I mean, Italy was the 5th largest economy in the world at the time, almost went bust, as did Spain, which was the 8th largest economy. So 2012, we have this massive financial crisis in Europe based on governments almost going bust. So again, the ECB now start printing money as well. So the only solution to servicing this gigantic debt load is printing more money, which drives even more debt as yields go down. So now we've got a situation where the world is about 400% of GDP in debt. The US is 100% of world GDP in debt. It's the most indebted economy the world has ever seen. So when you've got a very indebted economy, if you raise interest rates on people, it hurts fast. We've got ourselves in this very fragile system where anything can break it. And governments everywhere, we've just seen it with the UK, we've seen it with Japan, everyone's trying to paper over the cracks to try and stop this thing falling apart. Because if it does, it's the end of the entire financial system and most of the global government bond markets. So it's an extraordinary moment in time we're living through. And it was that living through and predicting this in 2008 and 2012 was why in the end I realized I had to do something about it. Both firstly educating people about it, which was the birth of RealVision, which was I want to democratize the kind of information that I could get being at the epicenter of the financial system and give it to everybody. And it was also my journey into crypto as well, was that period in time, realizing we needed to find another answer because this is not the answer. Debasing currencies endlessly, taking on more and more debt to try and keep the thing going doesn't work.
We are indeed in precarious times, and it is only a matter of time before central banks like the Federal Reserve realize that printing more money will not solve the problem, but bring on greater economic collapse. What do you think about Raoul Pal's interview and the current state of the global economy? Please drop your comments and observations in the comments section below. Also, sure you hit the like button, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.